Okay. Okay.
Good morning. Good morning, team. Martin can hear me clearly. Can you hear me? Somebody to confirm? Great. Nice. Thank you, Silas. Thank you. Thank you. Thank you for joining. My name is Victor Calero. I'm a consultant here at Liaison Group under risk and insurance, and specifically for employees' benefits. Now, for the topic of the day, liquid legacy, that is securing your future and legacy using life insurance. For generations, we've been taught that the best way to secure a family's future is through physical assets, and such assets might be through, or rather in properties. Some areas that believe that you have to secure a future through property. Others will do livestock. There's others that are doing land, and most people have ventured ultimately into businesses. But as the world changes, so does the way we build and protect wealth. Traditionally, or rather, the traditional assets sometimes can lose value. Some can take time to sell, or even become costly to maintain. And when the unexpected happens, when in the event that the breadwinner loses their lives, These assets don't always convert into immediate financial support for the people that we leave behind, or rather for the people that we love. Now, this is why many people are now shifting from relying solely on physical assets to embracing what we call a liquid legacy. A liquid legacy is just wealth that is accessible, a wealth that is immediate, and wealth that is guaranteed. And one of the most powerful tools for creating that liquid legacy is life insurance. And this is one of the most effective, yet often misunderstood tools for long-term security. Not just as a payout, but as a financial strategy, one that protects your loved ones, one that strengthens your financial foundation, and builds a legacy that lives beyond you. Now, without much, I'll welcome Victor to continue on the same, rather to now take up the discussion of the day. Victor.
Thank you very much, Victor, for laying the foundation for today's conversation, where we are going to be focusing on a liquid legacy, the alternatives that are available to us, maybe away from or complementing what traditionally has been viewed as a way of, stocking up wealth and even being able to transfer it to our heirs or beneficiaries. And this is in line with what we do at Liaison Group, being a non-banking financial institution in the business of risk and insurance. We also do healthcare administration, pension administration, investment advisory, and trusts. So all these pillars have come together today to inform our conversation on liquid legacy. As you'll be able to see as the presentation unfolds, all the listed areas of our expertise actually get to contribute to be part of the source for what now we will be referring to as liquid legacy. So I'll go right into the agenda of the day, trying to break down what liquid legacy is. And as Victor tried to allude to, the immediate and readily accessible cash or cash equivalent assets, either by way of maturity. For example, if it's a life policy, if now the maturity benefits get to fall due, of course, that windfall is accessible immediately. And if it is a death benefit from any of the policies, as we'll be able to break down in the slides that will be coming forth, then that instant cash provides, that instant cash is what we're referring to as liquid legacy. And it can be able to benefit yourself as the owner of the policy, and also be able to extend the similar financial support to your dependents or beneficiaries that you would have nominated. So life insurance then provides that liquid legacy bridge that if you would like to be able to set up that investment portfolio or that trust that will be holding these benefits, then life insurance plays that pivotal role of ensuring that it is bridging the dream that you have to the reality that you wish to live for yourself and, of course, for your beneficiaries or dependents that you would have nominated. So the two key benefits under liquid legacy are one, of course, it protects your future and that of your family. And it helps in preserving your legacy by minimizing disruptions, because you understand that even in inheritance, there are taxes that would apply for the transfer of that property. And if there's subsequent trading or exchange, rather, disposal of those assets, then there are taxes that would attach to the sale of those assets under your estate. So we are providing an alternative to minimizing the loss that comes with the transfer of wealth from one generation to another, and also just providing tools that are then able to maximize the windfall that would be realized with the enactment of the liquid legacy proposal. Sorry. So the infrastructure is quite straightforward, and this is how we are able to achieve the setup of the liquid legacy and its operationalization, that it provides immediate liquidity for investment or now for the estate needs that will be coming forth by injecting quick cash into either the investment portfolio or the estate of the founder. So for example, when somebody passes away, there's a possibility of immediate expenses that would come with that passing. So for example, the transfer of assets to the heirs that you would have left behind, the continuity of the businesses that should be running. For example, if there were creditors that were then, the properties were tied to creditors, you might find that there's a need for liquidation to be able to meet the needs for the creditors. So that immediate cash injection that would come from these life insurance policies then would provide some form of reprieve or give comfort to the heirs or dependents that are being left behind. So as opposed to having them liquidate those assets to meet the immediate expenses of your estate, that cash injection would be used for that matter instead. So equalizing inheritances and protecting family wealth. There are assets that you own that are not necessarily, equally divisible amongst your children. And a classical example is a case of a business that you're leaving to one child, and maybe now the other cash equivalents that you own that you'd be leaving to another child. So the windfall that would come from life insurance would be providing a suitable avenue for redistribution of now what is being left behind. And with this, you are able to quash the family squabbles that could come up, and also ensuring that you are equitably, if that is your desire, being able to meet the needs of your descendants or your beneficiaries. Of course, we've spoken about minimizing taxes and wealth transfer. So enhancing wealth transfer is ensuring that as maximally as possible, what you desire to transfer to your dependents or to your descendants is reaching to them maximally. And of course, life insurance provides a very tax-efficient tool, both for building legacy and also being able to transfer those proceeds of those properties to your dependents. Number 4 is being able to tailor your cover depending on the stage you are in life. So for the young families, of course, the primary need is protection. So you're looking for an insurance solution that would either work as an income replacer or continue the vision that guarantee a cash payout in the event of loss, either death or permanent disability. So if you lose your earning power, then these policies would work as an income replacer. So for business owners, especially in the event that somebody would like to sell off their shares, or there's a loss of a key man, a key partner in the business, then also this insurance would be providing, or rather life insurance would be providing an avenue for ensuring that there's business continuity, because then it will take care of the interests of the buyer and also anticipate the risks that are associated. Yes, the risks that are associated with the keymanship ownership of the business. For retirees, and this is hugely, it's big on legacy. That you'd see that majority of the retirees then would be looking for whole life policies, for example, the permanent policies that emphasize on being able to leave behind a windfall for capitalization of the dependents that would come forth. So I'll be going through the insurance policies that support the idea of liquid legacy. So what policies can you take advantage of that are available in our Kenyan market? So we'll be looking at the policy type and why it best fits the idea of liquid legacy. Then we look at the key advantages that policy presents, and perhaps now the typical use, how you can be able to, or rather the type of population, depending on our needs, that policy would be appealing to. So a whole life policy guarantees permanent coverage. the only benefit that comes from a whole life policy is the capital benefit. And currently, how our market is rolling out this benefit is that you can either choose to pay premiums for your whole life. So, for example, you start paying premiums at age 30, and you say that you would like to pay it, until your last day. Yeah. So, upon the event of death, the whole life policy would pay whatever sum insured you had chosen for yourself. Yeah. So that payout would provide a windfall that can then finance either an investment portfolio that you had or be paid into a trust that you had set up for the benefit of your descendants or your dependents. So how our market is also administering this whole life policy product is that you can also decide to say that you're only going to pay premiums for a period of, for example, 10 years. Yeah. 10 years or 15 years or 20 years. So that policy would be fully paid up. The maturity benefits would be paid in the event of death, but then you stop paying the premiums either after 10 years, 15 years, or 20 years. So later on, you'll see a model that you have created that then is able to anticipate the different policy options that you can choose from and the windfall or cash payout benefit that comes from those benefits and how they can be reinvested, to finance your legacy. So the whole life policy, of course, guarantees coverage with the cash value growth, and it allows for tax-free loans. You can be able to borrow a loan against your life policy. You see, for example, for commercial banks and even the SACCOs that we belong to, you'll be required to provide some form of guarantee for the loan that you are taking. Yeah. And the biggest guarantee that majority of these financial institutions are going for would be credit insurance, that you're guaranteeing that in the event of death, then there's a policy that will pay the loan balance at that given point in time. Yeah. So if you have a life policy, you can be able to use it as a guarantee for any loan amount that you're taking, provided the amount that you're taking on the loan is less than or equal to the value of your life policy. So there are lenders that would not work with the entire loan amount that you're taking, but would rather opt for a percentage. For example, they would allow you to borrow up to 70 or 80% of the value of your whole life policy. So instead of taking up another insurance to cover for the loan, which would increase the loan cost, you can be able to use your whole of life cover as security for that loan. So the key advantage for this with regards to legacy planning is especially on the windfall. So the payout amount that is coming from the administration of that policy. And of course, that can be used to either now finance debt or even now continue the vision that you had for your family. The typical use case is for high net worth individuals or families and business owners, looking to preserve wealth and ensure continuity of the business venture. So the other type of policy is the endowment plan, which guarantees both savings and protection. So you have set a goal that you wish to achieve, and you're also looking to have some form of protection, even as you sojourn towards achieving your goal. So of course, it combines what will be guaranteed as the savings together with the interest that is earned, and also guarantees a payout of a maturity benefit. So of course, the endowment plans come structured with a period that will be required to service the premium obligations for that policy, and also guarantees a maturity benefit, a payout amount that is deferred into a period in future, depending on the length of the policy that you have procured. The key advantage is that, of course, you are guaranteed their fixed returns, depending on how the financial markets are operating, and the bonuses that are declared in these life companies. And it also then guarantees a level of protection, that in the event of death or disability or critical illness or ill health, there is a compensation that is guaranteed so that you can get to benefit from that policy while you're still alive. The typical use is for young professionals that are looking to save for a future for themselves and their children, and also for retirees that are looking to build a legacy, either for family or for self during those sunset years. So our market also has unit-linked insurance plans, and these ones are very flexible in terms of investment, and also can be used, as cash deposits, because the unit links that we have in our market allow you to do partial withdrawals. So then it is combining what you should ideally get under an ordinary life insurance policy and what is guaranteed now from the investment bit of the policy. So you would see that a majority of the unit links are also looking at investing in either equity funds or the bonds that are floated in our markets, including the one that has recently been floated by Safaricom that you can access in our current commercial markets. And it is very critical in providing dynamic liquidity. Like I mentioned, you can be able to make partial withdrawals to meet any urgent or immediate capital needs, even as you look to build your liquid legacy dream. So the key advantages that we can be able to fetch from this, of course, is being able to, the partial premiums that are invested to be able to grow the overall fund that you have under your unit link, and being able to access, making those partial withdrawals in the event that you have a capital need. And this one is typically used by individuals that are seeking growth alongside protection and ensuring that there's business continuity, especially with the capital injections that it allows. So this is a quick recommendation matrix, of course, depending on your personal need. How can you be able to do a self-assessment to determine which kind of insurance policy would best work for you, even as you look to build your liquid legacy? So the first situation is for an individual that is looking for guaranteed growth and lifelong protection. So guaranteed growth, meaning that the fund that you have created continues to grow, and there is a guarantee that at maturity, and majority of this, the policy that is recommended here is a whole life policy, and a maturity benefit that would be paid would be exclusive to the event of death. So why this one wins for liquid legacy is that there is predictability as to the amount, the cash value that would be gained from this policy. Of course, you get to enjoy the tax benefits that come with life insurance up to 15%. It can be able to be used as security for loans that you are taking. And of course, the biggest guarantee is that you can use it to cover for any potential succession disputes. So currently, you can be able to take up to 300 million Kenyan shillings as a sum insured for a whole of life policy. Of course, with other requirements such as the requirement to provide medicals, that is for the free cover limit. And of course, the premiums that then you get to pay on a monthly basis would be dependent on a number of variables.
All right.
Thank you. Kindly mute. So the premiums that you'll be paying for a whole of life policy would be dependent on a number of factors. They'd want to know whether or not you're a non-smoker, whether or not you have any pre-existing conditions, and there are a number of medical examinations that you'll be subjected to just to determine the premiums that you'd get to pay. Yeah. So for some insured of say 100 or 200 million, then you can be able to provide a sufficient windfall to finance your liquid legacy dream. So the other situation is for individuals that are into long-term savings with a maturity payout. So you are looking for both protection, but if you get to live the full term of that insurance policy, then you are looking to also get some form of payout for yourself. So the recommended policy for individuals in such a situation is an endowment policy. And why that wins for liquid legacy is that then it builds a nest for your heirs and for yourself. Yeah, that you can be able to work towards a dream. There's a fixed period that you're looking to achieve it within. And if you actually get to reach to the maturity period of that policy, then there's a cash out, a cash payout benefit that is guaranteed, together with any accrued benefits or bonuses during the life of that policy. The last situation that we have sampled is a market-linked upside with flexibility. And the recommended policy there is a unit-linked policy that then is able to anticipate that, yes, you are getting investment returns on the premiums that you're paying, but you're also doubling it up by also getting some form of protection against the risks of death, disability, and critical illness that would be paid depending on the structure of the policy. And why this wins for Liquid Legacy is that, of course, you are getting growth from the investment income that the unit link policy is earning. And you're also being able to make partial withdrawals for any emergency capital needs, perhaps for injection into a business. So the practical model is a classical example of how then you can be able to structure these different policies into a legacy project that can be self-sustaining. So on our extreme left are the different sources of funds, that the Liquid Legacy project can be funded by different sources of funds. The primary one that majority of us get to enjoy without getting to spend for it is group life, that majority of our employers have procured a group life assurance policy for their staff. And from this policy, then of course, if there's any cash payout from the different risks that are insured, so be it death or disability, so that cash payout can be paid into an investment portfolio or a trust for the benefit of now yourself or your beneficiaries, of course, depending on the nature of the risk that gave birth to that payment. So if the risk that gave birth to that payment was death, then of course that benefit would be going to service the interests of your dependents or your beneficiaries. Similarly to an endowment policy with a maturity value, you can be able to either nominate a trust as a beneficiary to the policy proceeds coming from that endowment policy that you bought, now for your own benefit or for the benefit of your beneficiaries. And when the maturity benefit is paid, then of course now it will be going to service the financial needs of yourself and that one of your beneficiaries. So the other term insurances, such as a whole of life, which as I mentioned, provides the biggest windfall when a maturity benefit emanates from it. So the whole of life payout, be it 50 million or 100 million Kenyan shillings, would be paid into the trust or investment portfolio for the benefit of your beneficiaries. The same applies to your pension benefits, that if you'd like to structure a similar model, then you can nominate that investment portfolio that you own or that trust that you've set up to receive the benefits coming from your pension for the benefit of your beneficiaries. So how you are able then to convert this into a legacy and create that cyclic effect is that once this benefits from the different sources, be it group life, be it an endowment policy, be it a whole of life cover, or be it your pension proceeds. For example, if they are paid into a trust, and in the trust deed, you have nominated beneficiaries that get to access, or rather get to benefit from all these policy proceeds. In that trust deed, you can still then require that an insurance cover is taken upon the life of these beneficiaries or these dependents, and the policy proceeds from those lives that are being funded by the proceeds of the trust then get to buy those dependents or beneficiaries their own life policies, of course with a precondition that the beneficiary for the policies that the trust has taken on behalf of your descendants is the trust. Yeah, so that would create a cyclic effect that when the trust receive the windfall, the investment income from the windfall in the trust is used to finance life policies, an example of endowment or whole of life for the beneficiaries under the trust. And given that the trust is financing the premiums for your descendants or for your dependents, then of course the pre-requirement here would be that when the trust finances their premiums, they have to nominate the trust as a beneficiary for those benefits. Yeah, so it would create a cyclic.
Simu mnapiga inaenda nje.
Kindly mute. Thank you. So it would create a cyclic effect whereby you are the founder of the trust. You've gotten a windfall from the policies that have paid the maturity benefits into the trust. Your beneficiaries, of course, get to enjoy the investment income that is coming from the trust or investment portfolio that's been set up. And to ensure that there's that cyclic effect of continuity, you also require that, from the investment income coming from the investment portfolio of the trust, there are policies that are financed for these descendants, and the maturity benefits from the policies that have been financed by the trusts are paid back into the trust, so that if your beneficiaries also have beneficiaries, they get to enjoy the benefits that are guaranteed under your portfolio. So this liquid legacy model then has the potential of creating generational wealth, because that cyclic effect would be going from generation to generation, and it will be able to create a perfect model for that wealth transfer, because in the trust deed, you could be able to anticipate the needs for those dependents, be it housing, be it education, be it any form of medical intervention, that they're able to be taken care of by the liquid legacy model that we have created. So I think at this session, we can be able to interact on any questions that could be coming up from our attendees, or any clarifications that we might need to give. Thank you. Yeah, so if there are any questions, you could be able to either type them on the chat or just raise your hand, and we'll be able to unmute for you to ask that question. Thank you. Yeah. So I can see that majority of the correspondence that we are getting on our chat session are coming from our personal AIs. Okay. Let me see. Great. So maybe for the benefit of the members that have joined in the last 5 minutes, just a quick recap of the final slide of our presentation is that you can be able to stack up or structure the different sources of insurance proceeds. Be it a group life, you can be able to, for example, nominate a trust as a beneficiary to your group life benefit. You can be able to nominate a trust as a beneficiary to your endowment policy proceeds. You can be able to nominate a trust or an investment portfolio as a beneficiary to your whole of life insurance proceeds. And the same applies to pension. Yeah. And once this, the benefits under these different sources get to mature, for example, for a whole of life policy, if the final benefit is paid into a trust, you can be able to provide some form of instructions on the trust deed as to how you would like for those proceeds to be utilized. And part of utilization for those proceeds, for example, would be to take care of, so if you're getting these benefits from a policy that pays on maturity, not necessarily death, then you can be able to enjoy those policy proceeds yourself. Yeah. If it is coming from a whole of life policy that only pays in the event of death, then of course you'll be leaving those proceeds behind for your descendants or for your beneficiaries. So through the trust deed or the instructions that you're leaving behind, you can be able to dictate as to how then your beneficiaries get to access those policy proceeds or the investment income that would be coming from them. So you can be able to cover for their housing need, for example, if you would like to provide housing for them. You can be able to cover for their education needs, and you can be able to cover for their medical needs. So the most important bit of creating that liquid legacy, or rather being able to bring the liquid legacy model to life, is introducing that cyclic effect, that part of the investment income that is coming from the policy proceeds that were paid into the trust, a part of that income can be used to finance life policies for your descendants, with the requirement that for the life policies that this portfolio is buying on their behalf, they have to nominate that portfolio or that trust as a beneficiary for those benefits. And the same can be applied to now their dependents, which now in this case would mean your children get to benefit from your portfolio, and their children also get to benefit from the policy proceeds that were paid back into the portfolio using the investment income that came from the trust setup. So that cyclic effect, of course, would be creating cash accessible benefits to yourself and your dependents, and that more or less compounds the whole idea of liquid legacy. So Victor, if you can moderate a quick session on any potential questions, we can be able to wind up there. Thank you.
Thank you, Victor. Thank you for that presentation. There's one question in the chat box. Is the policy inflation protected?
Good question on whether the policy is inflation protected. The answer is no, because majority of what would be declared as bonuses would be net of any market variables that are in force, of course, including inflation. Yeah. So whatever return that is guaranteed as an investment income from, for example, an endowment policy, would have taken consideration of the variables in play in the market. So at the end of the day, you'd be looking at what return is being guaranteed under each of these policies vis-a-vis now the prevailing inflation rate in the market. So the difference then would be speaking into what you get as a net return. Yes.
Thank you. Another question: if the insured dies before the policy maturity, will there be bonuses given to the beneficiaries with the sum assured?
Very good question, and it is very forward-looking. Yeah. So the whole operationalization of the policy provides a framework, for example, for nomination of beneficiaries. Yeah. And there is a guaranteed payout for that policy from the point of inception. Yeah. So if the key event that was insured, a classical example is a pure life policy. So in the event of death, yeah, the full sum assured, if you had bought a policy for 10 million, that 10 million is what is going to be paid on the event of death or disability, depending on how the policy had been set up, including all the accrued bonuses for that matter. Yes. Yes. So I think the question was on whether you get to access both the bonuses and the sum assured, and the answer is yes, you get to access both.
Great. From the box, that was the last question. But the floor is open. If there's any question, please unmute and ask. Please.
I have a question.
Yes, please.
Hi, Victor. Thank you. Good to see you. My question is, if insurance is really good, why is the uptake really low?
Very, very, very good question, especially on the uptake. Because the current insurance penetration in Kenya is about 3%. And the biggest challenge with regards to that penetration has been on, on education. That for the longest time, information on these policies, how they operate, and what is required of the insured has not been available to consumers in the market. Yeah. And part of the initiatives to correct that situation has been to invest a little bit more in capacity building. And that is the reason why we are also having this webinar today, to try and disseminate and build capacity in terms of the information on these policies and how we can be able to blend them into our daily living. Yeah. So as opposed to putting these products on a shelf, we have tried to go a step further and incorporate them into our daily living. Yeah. So for example, when you're looking at legacy planning, you get to build your legacy on a daily basis. You don't build a legacy, for example, for one day. Yeah. So you can be able to incorporate these insurance policies in your daily living, even as you build your legacy, for both your benefit and the benefit of your dependents. So yes, penetration has been a challenge. So 3% is very small, but to assure as we continue to build capacity, then we're gonna see a lot of improvement in terms of uptake. Yes.
Yes, Millicent.
Thank you. My question to you, Victor, it has been answered partly regarding whether in case of demise, the member will be reimbursed. So what happens if the member had defaulted a few months to the demise? What happens? How do you treat that?
Yes. So there are policies that react a little bit differently when it comes to default. There are some that would suggest that default would lead to forfeiture. And then there are some that are open to restructuring the benefits. So for example, if a member defaults for 3-4 months, then you can be able to defer the maturity period, either for a similar period of time or longer, with the requirement being that, you have to recover on the payments. Yeah. So as opposed to the traditional insurances that were there, that were a little bit punitive when it comes to collection of premiums, nowadays you can be able to negotiate, yeah, especially once a policy attains a maturity value, which is usually for majority of the policies in our Kenyan market, is after a period of 3 years. So with the maturity value, then it becomes very difficult for you to lose out on those policy proceeds. So we have policies that also allow for a premium loan, which means that you can be able to finance part of the premiums that are required from the policy, from the premiums that have already been collected on that policy. So increasingly, we are seeing a lot of flexibility when it comes to restructuring those payments, because of course we are alive to the fact that sometimes financial constraints might lead to either a delay or non-payment of the premium that is due. Yeah, so there's room for negotiation of a recovery plan for you to catch up on the premiums that have not been paid in exchange now for a deferred maturity time. So you would see that if you are catching up on 8-9 months of premium, then the consequence is that the maturity benefit is going to be deferred for almost a similar period of time. But you can also request to get a policy loan from what has already been collected as premium for that policy. So at no point in time will you lose out on, will you forfeit the policy due to non-payment of premiums. Kindly always insist on being able to negotiate for a plan to correct the situation. And we are also available to help should such a situation arise. Yes.
Thank you. Any other person? From the chat box.
There's a question on the chat on
Yes.
major exclusions to note. So there have been a number of changes, especially in the life market. The standard exclusions usually relate to, intentional exposing yourself to harm intentionally. Though with the decriminalization of suicide sometime last year, currently death by suicide for majority of the policies in our Kenyan market is not excluded. Some of them would impose a waiting period, for example, for 1 year. So the benefits would be able to mature even if there is death by suicide after a period of 1 year. Then, of course, the other standard exclusions, the risks that relate to piloting. So if you are flying not as a fare-paying passenger, majority of the providers for life insurance would want you to fly as a fare-paying passenger for aviation risks to be covered. Then, of course, the key exclusion or the key requirement when it comes to life insurance is compliance with medicals. Yeah. So all these policies will come with a free cover limit, which in layman's terms is a non-medical limit. So up to amount X, be it a pure life policy, be it an endowment policy or a whole of life, you will be guaranteed coverage up to amount X. Let me use 10 million or 7 million, which is more or less the current average. You'd be covered up to 7 million without the requirement for proof of good health. Yeah. So if you are buying a 20 million or 30 million or 40 million policy, then you are being covered up to 7 million without a requirement for medicals. But for you to access the full potential limit, then of course you have to comply with that requirement for medicals. So for majority of, due to that gap in capacity building through training, like the one we are doing today, you get to, some members get not to access the full benefit due to that medical non-compliance. So part of capacity building is ensuring that you get to understand the conditions that come with that policy and what is required of you to ensure that you are accessing full coverage. There's a question on the chat on whether the policy can be changed or upgraded in future. Yes, there are policies that allow you to top up on what would be the potential benefit. And there are policies that don't allow for that flexibility. Yeah. But the goodness with life insurance is that given that you cannot quantify somebody's life in terms of a sum insured, you have the freedom to take multiple policies with different providers in the market. The only limiting factor, for example, that we have is that one underwriter X cannot allow for you to take up, for example, policies of more than 500 million with them. Yeah, but it does not mean that you cannot go to underwriter X and take an equivalent amount. So the only limiting factor when it comes to life insurance is usually affordability. So you can't be able to take as many policies as you can afford. So if you're looking to upgrade, as opposed to if now the policy that you have does not allow for upgrade, would recommend that you take another policy to be able to supplement for that need that you could be having. The other question is, what happens when I'm unable to continue paying the premiums? I think I tried to answer this in part. What is available to you is, one, to negotiate for a restructuring of that policy. Yeah. That if you can't be able to, especially if that policy has not attained a maturity value, then of course there's a risk of forfeiting whatever has been paid in premiums. And the average maturity period for majority of policies that we have in Kenya is 3 years. Yeah. So if unfortunately you are not able to honor the premiums before that policy attains a maturity value, a majority of those policies would mean that you get to forfeit the benefit. Yeah. But before you resign to that fate, like I mentioned, it is important to negotiate so that you get a grace period to catch up on the premiums that are required in exchange for a deferred maturity period for that policy. So for example, if it was a 10-year policy, then deferring the maturity value or period would be, for example, negotiating for now 11, 12 years, just to give you some grace period to catch up on the premiums that had not been paid. Yes. Great. Yeah, so Victor, we don't seem to have any more questions from the chat.
Yeah. We can take one more question before we call it a day.
Okay. Okay.
Do you have any question? Just to mention that this conversation does not end here. The event that you have a question, maybe let's say going forward, you can always get in touch with us and we will get back to you. So thank you so much, team. Thank you so much.
Thank you.